Hello, my name is Carlos McWhorter, CPA, and today we have an analysis of Netflix. We're going to take a look at the streaming giant, look at the fundamentals, and see if this is a quality business. And we'll take a peek at the valuation to see if we believe this current price of $795 is a great price to enter into, or is this a quality business that we want to keep on our watch list to maybe enter to a position later on. So let's get right into it. So looking at Netflix, again, right now trading at $795 per share. Looks like you could have got this stock at about 170 in 22, which they had a nice run since then. But we're going to look at the valuation to see if even now at 795, is this a good price for this business? Right now, they're trading at a PE ratio of 44.8 times earnings. That's a pretty high PE ratio, so we'll keep an eye on that. Trading at earnings per share of $17. So again, PE ratio, you have to think about it. This is the rate that in which you're buying $1 of earnings. So even though the price is $795, this PE ratio says you're spending $44.84 for every $1 of this company's earnings. So of course, a company has to be in a high growth state for me to justify paying a PE of 44. But again, we'll look into the business and break that down. So first, let's look at the business segments. How does this business make their money? So right now we have pretty much all streaming. Small percentage of people are still buying DVDs. So they're still making $82 million from DVDs. Somebody's grandmama somewhere is still getting DVDs from Netflix. But most of their revenues, almost all of it, is streaming. So we know Netflix as a streaming platform, and this breakdown of their revenue sources proves that. So let's go to revenue trends. All right, so we have last 5 years growth of 16%, 10 years, 22%. So this is the medium to potentially high growth state of the business. 2014, they were at $5.5 million. Now they are at 5 billion to 33.7 billion in 23. 37.5 billion trending now for the last 12 months. So for 2024, pretty solid trend, pretty decent growth rate in the double digits, except for 22 and 23, but it looks like they're back in the double digits this year with 11.4% growth. Margins also look solid. Gross margins, 31.8% in 2014, 45.2 right now for the trailing 12 months. Let's look at the graph showing their revenue trends. Solid, consistent growth over the past 10 years. So that's what we like to see. So that looks good. Let's look at profitability, their net income. So they've been growing their net income at a much higher rate than their revenues, which means they're becoming a more efficient business, which should happen as a business matures. So that's a great sign. $267 million in 2015. $7.7 billion trending for the past 12 months, 5.4 last year. So solid growth. We see they have 2016 and 2023 were their only years of negative profit growth, where net profit went down. They've been positive each year, but they went to 5.1 to 4.4 and 267 to 123. So only 2 years out of the past 10. So that's solid. Even more important, as we saw with gross margins, net profit margin is growing as well. So their bottom line was at 4.8%. That means for every $100 that came in, they kept about $4.80. Now for every $100 that comes in, they're keeping about $20. So excellent growth of their net profit margins over the past 10 years. That's what we like to see as well. Now going into the free cash flow. So a little bit different story here. Significant growth over the past few years, of course. 1.9 down to negative 132, 1.6, 6.9 now to $7.1 billion. Consistent growth there. But we see they had many years of negative free cash flow. As you see, businesses that are growing, that are trying to establish themselves, they're going to have lots of capital spend. So a lot of the cash that comes in, they're going to be spending that. They're going to be selling shares, taking on debt, bringing in capital any way they can to continue to support and grow the business. So we see they were doing that, but they had a significant turnaround here in 2020 where they had no more significant losses. One small loss here, but again, over the past 2 years and for the trending of this year, they have been consistent in growing their cash flow. So we like to see that. That's a good sign there. So balance sheet. Okay, so I'm going to look at their debt balance and compare it to their free cash flow. I want to know how fast can this company pay off their debt. We like 3 to 5 years, depending on the business. So I have right here that they are in a poor leverage position because in the past 5 years, they've been at 10.2 years to pay off their debt. Now, this is because we have that significant or minor loss here in cash flow, but beyond that, they've had consistent negative free cash flow, which means they cannot pay off their debt with their cash flow because they didn't have any. But again, we see a turnaround in 2020, and now they're in a good position of being able to pay off their debt in 2 years. So currently the balance sheet is in a healthy position. Historically, it has not been in a healthy position looking at the debt to free cash flow. So we'll keep that in mind as we move forward, especially when we get to the evaluation of the business. Now, moving on to the shares outstanding. We're skipping dividends because they don't have any. They're not paying a dividend. So what am I looking for when it comes to their share policy? Preferably, I like a company that is buying back shares. I want a company that's repurchasing their shares with their free cash flow. And also, when they're doing that, they're giving me more value as a shareholder. Sometimes it is good for a company to sell shares, as we see they started doing that here. They're selling shares, now they're buying back shares. So we like this trend here, but we're not going to ignore the fact that they've been selling shares. Now, if we think about it, we looked at their cash flow. They had negative cash flow these years. So how are they going to bring in money to support their operations and continue to grow their operations if they don't have cash flow? And this is what they're going to do. They're either going to take on debt or they're going to continue to sell shares to the public, bringing on cash and supporting the business. So that's what they did for those years. So this is understandable, even though this is not what we like. Now they have some cash flow and they're repurchasing shares, pretty much reversing the impact of the selling shares over the less recent years. Personally, I'm not sure if I like this. Of course, I want shares to be repurchased, but is Netflix a business that has so much cash flow that they need to be repurchasing shares versus putting it into their business and growing their infrastructure? I don't know. So I like that they're repurchasing shares. If I'm holding shares here through this period, my shares are more valuable because they reduce the number of shares. That's what we like to see. Again, we want a company not just to repurchase shares, we want them to have a share policy that makes sense for their business. You have to answer this question for yourself. Is this company in the position where they should be repurchasing shares, or should they be looking for ways to continue to grow their revenues in the streaming space? And I say this because it's becoming a wide open space where any and every company is coming up with a subscription option. Even if they're on network, they have a subscription option. Now, Netflix has a lot of competition. They are successful. They are dominant. However, there's a lot of competition, especially as we'll talk later as they get into the more entertainment and sports space as well. So moving on to the economic value added. I want to know, is this company efficient or successful on how they deploy their capital? When I say capital, I'm talking about their debt and their equity. This is the money that they're using to fund their operations. So I want to look at the returns on their capital. What money is coming in compared to their capital? Also, what is the cost of that capital? What is the interest expense on the debt and the opportunity cost of the equity that's coming in? I want to know what is happening there. So looking at the return on capital employed, Netflix is at 23.15%. That's 3.2% over the average of their competition in the entertainment software space. Weighted average cost of capital, 7.2%. That's 2% lower than their competitors on average. So they have a spread of 5% over their competitors, meaning Netflix is creating value of about 15.8% over the past 5 years versus the average that they compete with, 10.57. So they are beating their competition when it comes to adding economic value to the business. So this is just a visual of showing the same thing, 23% of return on their capital. The cost of that capital is 7%. They have a spread of 15.8. So they are continuing to add value to the business. This is what we like to see. Gotta have it. They're adding value, so that's great. Showing that this is truly a quality business structure that's working out. They've gone into consistent profitability. They've gotten their cash flow under control. They're starting to turn positive cash flow year over year over the past 3 years, or the past 2 years in the trailing 12 months, I should say. So they're on pace to be at 3 years by the end of the year. So we'll see if we like this price. Now, Netflix is projected to grow at about 26% per year over the next 5 years. They haven't been doing that over the past few years, so that means there's going to be some expectations for them to continue to grow that top line in revenue and their cash flows. Some of that's going to come from growing revenue, and the other side is going to come from being more efficient. As we've seen, their margins has increased, which means they're creating more value and more revenues there. Discount rate is the weighted cost of capital at 7.3%. And I'm assuming a terminal value of free cash flow at 20 times. 20 times free cash flow. So looking at the average 3 years of free cash flow at 5.2 billion, growing at that rate with these assumptions, I see this stock being worth $514. A downside of about 35% from their current price. So my range will be $462 to $565 is my fair value range for this stock. Again, based on my assumptions, you may have more different assumptions than me. You may think this company is going to grow more. You may think that using the 3 average free cash flow isn't right, which means I would use about 7 billion free cash flow as a starting point. So you very well may come up with a different conclusion, and that's fine. However, based on my assumptions and the background to my assumptions, I'm looking at $514. Now, this doesn't mean this stock is ever going to come down to this price. It doesn't. My valuation of the stock doesn't determine what the public thinks of the stock. Clearly, people have higher expectations into Netflix than I do, and this is why they're paying $795 per share versus $514. With that said, I think that we're starting to see Netflix grow, or this streaming industry evolve continually. So I think there's a lot of growth, a lot of opportunity. As we see, Amazon Prime is streaming sports, live sports. We see Netflix, they're getting more into live sports as well with the Tyson and Jake Paul fight coming up. Like, I would have never imagined in a million years that Mike Tyson would be fighting on Netflix. But this is just showing you the potential in the streaming space. We also see that they have that gaming in the apps, and I'm just thinking, wait, what else are we going to see from the streaming industry? We see ESPN, they're getting to the sports gaming, the sports betting space. Is Netflix also going to enter that space later on as they begin to broadcast more live sports? We'll see. I think that's an opportunity for them to tap into that can potentially explode their revenue. So I think there's a lot of potential there. We'll see where they go. Now, looking at a scorecard summary of what we just reviewed concerning Netflix, revenues and margins are looking great. Same with their profitability. They're growing their profitability. Their margins are growing faster than their revenues, which means this company, as they mature, they're becoming more efficient. So we love to see that. The free cash flow trend, it is a positive, but with some caution. They haven't had positive cash flow over the past 5 years, but they have over the past 3 years. So we're going in the right direction. Same with the balance sheet. Currently, they're in a great position to being able to pay off their debt in 2 years. However, it hasn't been that case throughout its tenure or history. So the past 10 years looks pretty rough, but currently pretty good. So hopefully they continue that moving forward. No dividend. Shares outstanding. This one, they're selling shares. They're adding value to the shareholder, but it's caution because I'm not sure if that's the best choice for them. Remember, the next one is value creation. They're creating about 15.8% in value per year based on their returns on capital versus their cost of capital. So should they be taking some of that money and putting it back in the business, getting that net 15% return versus buying back shares? I'm not sure. I'm not sure if either one is possible. I would be happy. I'm happy with either one, but I don't know which one is best. So that's why it's caution right there. They're selling shares, they're buying back shares, repurchasing shares. Is that the best thing for them to do at this stage? I'm not sure. Then we looked at valuation. That's X because it is overvalued based on my assumptions. So that's a quick analysis of Netflix. I hope you found this video helpful. Let me know in the comments if you own Netflix and you plan on holding it for a while, or what you think about their future. Do you see them going more into the sports space or more into the sports gambling space as well, which can potentially blow up that business? So let me know what you think, and I hope to see you in the next video.